The U.S. Fed Reserve raised interest rates again. However, whether the rate hike is by 75 or 100 bips is less important anymore. The key is that we are now more confident that high interest rate days will last longer than expected. This time, inflation is the combined effect of deglobalization, economic war, regional conflicts, and COVID-19. Before all these factors go away, the U.S. is unlikely to return to low inflation, and this will most likely be the situation in other countries as well. The global economy will get hit, and those countries with the most U.S. debts will be hit the most. Insolvencies are likely to happen in those countries, and historically we've seen precedents. For example, Argentina, Mexico, and Sri Lanka were all the victims. We always try to compare this time with the 1970s when the interest rate almost hit 20% and the recession lasted for almost a decade. But they are different. Our world has changed. First, low global inflation supported by cheap labor, low-cost Chinese exports, and cheap Russian gas are now history. Or second, the global trade system is being disrupted by U.S. economic sanctions, trade wars, and supply chain problems. The trust is lost. And without trust, there is no trade. Without trade, war will happen. Third, huge commodity needs and price increases will cause further supply constraints and demand shocks. Over the years, because of environmental, social, and governance concerns and the ability to leverage the global trade systems, the commodity sector has been largely underinvested in most countries. Now, with resource nationalism prevailing under current geopolitical dynamics, each country will need to rebuild its commodity reserves and guarantee its industrial sovereignty. So, different from 1970s, this time the supply side is mostly driving the high interest rates. Deglobalization and the pandemic caused supply shortages, which then raised the prices. We were spoiled by the era of globalization during the past 40 years and took it for granted that the course would not be reversed. The Fed is aggressively trying to raise interest rates to curb demand. However, until the world returns to an efficient and globalized economy again, high inflation will not disappear. Apart from much higher financing costs and even bankruptcy for some households and countries, high interest rates in the U.S. will likely cause effects on the global currency regime. Should the whole world still be U.S. dollar-centric? Or does it make more sense to stockpile reserves in essential natural resources and give Chinese yuan or RMB a larger international role?